action. Cue the all-time highs. Our happy day is really here again. Lee Munson, Portfolio Wealth Advisors, President and CIO, joins us now, either to make you happy or to make you sad. He joins us. Lee, what do you think of this market right now? Are you a buyer?
I mean, yes, I bought some stuff today for a client that had new money. Here's the thing. You know, I was a little bit bearish earlier this spring simply because the estimates for the second half of this year were way too high. That's why I was taking money off when the S&P was around 3,000. But ever since we had this yield curve inversion, what's happened? Estimates have come way down. For the calendar year, if you look at aggregate estimates for the calendar year, in January, Jen, they were 6.3%. Now they're 1.5. We're talking about a 75% decline in calendar year expectations from just 6 months ago, 7 months ago. So that's really your cue to buy any dip between now and January 1st, because generally you've got 6 to 12 months before that yield curve inversion really starts working its way in. Plus, we got 30 days of no news before earnings season. I mean, what if peace breaks out in Hong Kong? What if we get a trade deal like we did today or some thought of it? So I think you play the volatility, you buy all the dips, and then expect a Santa Claus rally mid-October.
All right, so Lee, let's talk about what's been happening in the market, some of the sectors that have been leading. It hasn't, been fun new growth things, right? It's been utilities, it's been real estate, consumer staples goes up every day. What do you make of those trades being so hot? Because it's not really like people get super jacked up about buying more shares of Procter & Gamble, but that's what's been happening in this market.
Well, I think Procter & Gamble is good at, a good thing to bring up, as well as utilities. Now, we all wish we had some utilities, 6 months ago. We all wish we'd bought Procter & Gamble when the activists, started raiding the boardrooms. But here's the reality. I wouldn't be in those defensive trades right now. I think utilities, come on, the valuations are ridiculous. I think if you want to buy Procter & Gamble, you're getting really excited about something with, high single-digit growth. I think the places where you want to look at why those things got so hot, what else is around the world right now that's left for dead, super pessimistic, and has a high dividend yield? And that's why I would direct people's attentions more towards, say, cheap, developed international stocks. You can buy ETF that's like EFV, which just gets the cheapest stocks that are, say, in Europe. And your dividend yield's over 4%, and you got to wonder what's wrong with all these weak European investors. They'd rather just put more money in the S&P, or they'd rather get negative yields in government bonds over there. I think that's where you have to get in. You have to get in. The time to buy utilities is not now. So go find the next utility defensive play for the next 6 to 12 months. And I think that's cheap European stocks. And I think to some extent, it's emerging markets if we see it come in a little bit more.
Yeah, some people would say you're crazy to go over to Europe. Look what's happening in Germany with manufacturing. Look what's happening with Brexit. And then on the emerging market front, I want to ask you a little bit more about that, because you've actually been looking at what gold has been doing to inform this bullish call on EM. Gold today, it has been doing quite nicely lately. One of our first down days in a while. What is gold telling you about emerging markets?
So let's do the EM first. So I use a lot of different things to manage money. And one thing I like to go to is my math models. I don't like to use the word quant because I think it's, I didn't go to Harvard. So when we look at math models and we look at the past and look at signals like yield curve inversions and all sorts of other little economic indicators in my secret sauce, when gold has a major volatility spike, meaning when gold goes up or down more than 20%, in general, you're going to see emerging markets do very well going into the future, especially on a 3-year forward run. So just from a mathematical quantitative study, gold is telling us that emerging markets are a buy right here. Then if you go to more of a fundamental common sense, are you smoking crack perspective, bull markets are born of pessimism. I remember when the S&P was trading with a dividend yield of over 4%, and everybody said, It's the end. America is dead. And that was back in early 2009. So it doesn't bother me at all about what's happening in Germany. I'm well aware of it. And we priced those lows in last year in the summer. A year ago, I was on this program saying, I think you buy Europe if you see 25% down. And that's what has happened. So I think you have to remember with Germany, this is very much like what happened in the United States. Remember, wasn't it just a week or so ago that their own little manufacturing studies that they do, their version of it, said something to the effect of there was not a single ray of light in any German sector. To me, that's the ultimate value play. That's the ultimate comeback. It's the ultimate March 2009 type of situation. So that's why we're buying Europe right now, because there's simply not a single person who likes it. And generally, that's the time to do it.
Lee, quickly, before we let you go, we haven't mentioned the Fed yet. Where does they fit into all this? Because it does seem in some ways like we've all assumed 2 more rate cuts, so we don't need to worry so much about where the Fed fits into the picture for at least the next couple months.
Well, I like how we always get so complacent, right? I think that if you look at the bond markets, really the people who I respect are factoring in 2 or 3 cuts. I think we could see 75 basis points before the end of the year. I'm not I'm not reaching when I say that. The Fed is part of the fundamentals of this market. We do have an inverted yield curve. They know that they need to pull back and tighten up. I think what's working and why I'm buying on dips right now up until January 1st, then my story is going to change a lot. But for between now and the end of the year, I think there's this presumption that the Fed is going to cut, this presumption that Trump's going to make it work, and the strange presumption that things will only get worse from a no-deal Brexit. How could that get any worse over in Europe? So I think that you have to accept the fact that even though it doesn't make any sense that the economy is going to do well going forward, if the Fed has to cut, just let the crowd take this as good news. Let the euphoria and all this good times happen. And by the time we get estimates coming into this year that all got sandbagged because the estimates came down so low and we surprised to the upside, that's when I think you have to walk it back and start taking off some equity exposure. But for now, I say you have fun.
All right, for now until January 1st. The good news is we'll have you back a few times before January 1st so the conversation can continue. Lee Munson, Portfolio Wealth Advisors President and CIO.
Thank you.